and welcome to today's Friday's report, the 17th of May. News events. Right, today I'd like to update, think about the CPI inflation. We have been waiting for the last couple of days, and true enough, when the inflation data came out, it kind of like, had those big moves, and the moves was actually bit bigger than anticipated. Anyway, when it comes to the charts, you will be able to see. But today, I'd like to discuss a bit on the inflation. So what's next for it? Okay. Now, hopes for an early rate cut were dashed when inflation data, though lower than the previous months, did not sufficiently decrease to prompt the Federal Reserve to consider a rate cut. According to CME report, the likelihood of a June rate cut is now less than 3%. Now, the year-on-year consumer price index came in at 3.4%, down from 3.5% the previous month, while the core consumer price index year-on-year came in at 3.6%, down from 3.8% previous month. The month-on-month core CPI, however, registered at 0.3%, down from 0.4% the previous month. So that was the result that was released. Now, comparing this with January's data, inflation has increased by 0.3%, indicating no significant improvement in the inflation battle and possibly suggesting potential further rises in inflation as well. Because if you look at this, it didn't go up. So to me, this is this is it enough? That's the big question right now. So now the question is that why could inflation rise? Why did I say that? Now, in Monday's report, I highlighted the importance of shelter and energy prices, right? Shelter costs, including rents, rose by 0.4% for the third consecutive month, and energy prices surged by 2.8%. Now, these two categories accounted for over 70% of the CPI increase. So, if this is not, if these two, shelter costs as well as the energy costs, continue to rise, it's not going to be easy. We even the Fed, you would say that forget about rate hikes, the 3 planned rate hikes, if this continue to go up. And even though they have announced that they won't be increasing interest rates, we cannot discount the fact that they can if these two costs over here goes out of hand. Now, looking ahead to the July FOMC meeting, there is a 32.8% chance of a rate cut. Now, this percentage here will rise if this continues to rise as well. Will drop, sorry. This percentage here will drop if these two rise. So we still need to be very careful looking at the shelter costs as well as energy costs and see. So with another set of inflation data still to be released, there's one more, right? That's going to come up until the next July FOMC. It is premature to make definitive predictions. The latest inflation figures provide temporary reassurance, the one that we just got, but are unlikely to prompt an imminent change in interest rates. With this still up, even though that one, you have the CPI year-on-year down, you have the core CPI year-on-year down also. I don't think it's going to prompt any imminent changes so far until the next CPI data. So whether rates are reduced in July, September, December will depend on future inflation trends. You cannot run away from that. And to add that, economic performance and any emerging issues in the financial systems or jobs market. Okay, especially jobs, we need to focus on that as well. Now, overall, when this CPI news was released, what was the market reaction? When market, I'm referring to the US stock market, right? So the stock market reacted positively to the news as investors had feared a worse outcome for the April CPI. So in the short term, the rally may continue. It has done that since the CPI was released. It has done that. And this upwards movement is also aided by a weaker dollar. So in the longer term, if inflation remains high while the economy slows, it could signal an eventual hard landing. Now, this is something that definitely the Fed wants to avoid. And like I mentioned before, yes, we have seen the US stock market moving up, moving up. But if you continue to have high interest rates and leaving it for longer than anticipated, eventually you're going to see the things weakening. We have seen jobs, right, drop. So if this data, non-farm data, don't surprise us anymore with a sudden spike like we have seen before recently with the 300,000 jobs added, then it goes below 100K, for example, then that are signs that these are the signs that the economy can slow down, can potentially slow down. So if you have inflation still at the highs and these jobs and all data is related to the jobs market starting to slow down, yeah, it could affect the economy. And that is a part where you can have a eventual very hard landing over there. Now, like I said earlier, this is what the Fed don't want. What the Fed hopes is of course for an ideal scenario, or some people call it the Goldilocks scenario, where inflation decreases without stalling economic growth. Okay, so short term, it's still moving up, right? But longer term, we have to see. So one more inflation data, we wait for that, and data's relating to inflation as well is important, and right up to the next CPI. If the next CPI shows that the trend is still coming down, inflation is still coming down, then fine. But if we do have a spike again in inflation, yeah, you're going to see you're going to see definitely the S&P 500. It won't rally anymore, but actually drop. Okay, that's the potential there. Okay, so that's the end of the report for today.